Hello everybody and welcome to this third video where I will be running over the top 5 hotel casino stocks. I have today selected MGM Resorts International, Caesars Entertainment, Las Vegas Sands Corporations, Wynn Resorts and Penn National Gaming. All these companies are obviously hugely present in the American market but also in the Asian market. Most of them focus on gambling live, meaning at their properties, but you also have a company like Penn National Gaming who are also very active in online betting. If we look at the stock performance, obviously they have been hugely impacted by the coronavirus, and as you can see, year to date MGM has dropped with 30.54%, Caesars with 15.79%, Las Vegas Sands with 25.77%, Wynn with 40.9%, and then surprisingly in the end, Penn National Gaming has actually gained 123.63%, which is highly attributed to the fact that they are present in online gambling, and basically all the people who usually goes to hotels to do gambling, they instead have to do it at home, which has positively benefited them, similar to a company like DraftKings. If we look at the net income for the last 12 months, we see that both MGM and Las Vegas Sands have had a positive result, whereas all the others have actually lost money. The companies have obviously been hugely impacted the last quarter with the closure of all the facilities, and it is therefore no surprise that the average profit margin over the 4 quarters are negative because the drop was so big in the last quarter. So these numbers needs to be taken with a grain of salt. Obviously there is risk until there is a vaccine in place, but in the long term these numbers will not be sustainable and they will return to green as some of these companies will get more people back to their hotels to stay and to gamble. If we look at the Beanish M score, it is just to understand if there's doing any funny business with the accounting, and as we can see it looks pretty well overall. There's a small warning flag with MGM, but it's nothing major. The same with the Sloan ratio, which looks at whether there's doing any funny business with the accruals. It looks pretty well overall. If we go to the return metrics, we will see that MGM had an extremely good earnings yield on 16.44, while as all the other companies were either close or had negative earnings yield. If we go to levered free cash flow margin, we will see that MGM on the other hand had a negative on 8.83%, which is not so good. Caesars with a very good on 19.33%. Las Vegas Sands with a small minus on 3.94%. Wynn again very bad with 19.27%, and Penn had a positive on 6.17%. If we then go into the balance sheet, we are obviously interested in to understand whether the companies has the financial strength to weather the storm or the issues that they're facing with lower guests due to the coronavirus. So if we look both at the current ratio and the cash ratio, all the companies are doing fairly well across the board, where at least Caesars are the ones standing out the most positively. If we look at the total assets versus total liabilities, which is a very important metric for me, I would like to in general see above 1.5. MGM getting close to that. Same with Caesars, but the rest is a little bit in the yellow warning flag area. Same with debt equity, MGM doing the best here, followed by Caesars and Las Vegas Sands. Looking at both the Wynn on 46.07 and 7.81 for Penn, that is in general a no-go for me, and I will not touch companies who has such a high debt equity ratio. So they are more or less out of the game from my side. Same if we look at the Altman set score and Piotrowski score, both of them follows pretty well. They look at the potential of bankruptcy, and again MGM, Caesars and Las Vegas Sands scores the best, while as Wynn and Penn are scoring the worst, again adding to me not really being hooked on these companies. Looking at the shareholder yield then, again I want to look at the total shareholder yield, where that includes both dividend and buyback, because I think it's important to look at it from a holistic perspective, MGM has given a small 1.25%. Caesars has given a minus 9.68%, which is due to issuance of new shares. And Las Vegas Sands has given an impressive 8.16%. However, it's therefore very important to check the modified payout ratio, where we can see that Las Vegas Sands has 128.94%, which means that in the long term, this type of shareholder yield should be unrealistic to maintain, while as on MGM and Caesars, that is obviously a lot more realistic. Going to the earnings per share and growth section, most of them had a negative earnings, so they will have a negative PE. MGM has a positive one on 6.01, which could go down. If it goes lower than that, it's a little bit of a warning flag, but at the moment I still see that as an attractive PE ratio, while as Las Vegas Sands has 116, which is again, in general, it would be a warning flag for me to buy in something like that. However, they are green because we're benchmarking against the general industry, and their Las Vegas Sands is still doing fairly okay. Earnings per share growth forecast, MGM has a negative, Caesars with a very, very interesting 27.5% going forward, and Las Vegas Sands with minus 6.38%. Same goes again with the revenue growth, very, very little for MGM. Looks very attractive forecast for Caesars, and a decrease in Las Vegas Sands. Then we move into the different ways to analyze as to whether the shares are potentially over or undervalued, and one of the ways is to look in general at the PEG ratio. However, the problem that we are having is that either these companies had a negative PEO or a negative growth forecast, which means that we cannot determine a fair value for these. So we cannot use this to determine today whether they are under or overvalued. If we go to my own fair value intrinsic estimator, which is basically my model that has a lot of input to determine and assumptions to determine whether the stocks are over or undervalued, we will see that it puts out 17.25 for MGM, which is a minus of 25.36 from today's share price. For Caesars, it is a minus 8.26%. For Las Vegas Sands, it's minus 2.83. For Wynn, the only one with a positive of 12.79, but as I've touched upon earlier, it's not that interesting due to their balance sheet, and the same goes with Penn National Gaming, which is also showing a estimated intrinsic value of minus 17.34% compared to today's price. Beta risk ratio, which means the risk volatility compared to the general market, we will also see that that is relatively high for these stocks. So that means that they are in these days volatile, which is no surprise given that there is a risk that there will come further lockdowns in the future if the coronavirus becomes worse and worse. Book value per share is another one to look at, and looking at all of them, they are overvalued. We look at the relative strength index, another one very important. Below 30, it is oversold and appears attractive. Above 70, it is overbought and becomes less attractive as there is a risk of a pullback. All of them are close to the 70 mark except Wynn. So that tells me that they are not as attractive from this point of view. Lastly, not leastly, I also think it's interesting to look at what the analysts say, not that I will follow them blindly in any way because they have their own agenda, but consensus rating for all of the companies are actually a buy except MGM, that's a hold. However, if we go down and look at the consensus price target, which means the medium price target, MGM has a downside on 18.10%. Caesars has a minus from 38.78, Las Vegas Sands and Wynn has upside, and Penn National Gaming has downside of 21.29%. So relatively aligned with my own estimated intrinsic value of these companies. So in the end, Would there be any of these companies that I would invest in as of today? The simple answer is no. I would not invest in any of these companies simply because I don't think that the price that they have looks attractive compared to the risk going forward. I would say if there comes a pullback in MGM and Caesars Entertainment, they will definitely be the companies that I would look the most interested in buying versus Las Vegas Sands, Wynn and Penn, which I have a bit more reserved about. But again, it will require a pullback for me to go into these because I am still fearing that we will see lockdowns when the fall and the winter season starts again. So again, not gonna go that way, but keep an eye on them, and if the prices falls substantially enough, I may enter into a position with them. I hope that you like the video. If you do so, please give a like and a subscription for future videos. If there are things that you would like to see differently, or you have comments or improvement for suggestion, please write a comment, and I will try to do better in future videos. Have a good day.